And there you have it. The markets are officially closed on this Wednesday, October 29th. Welcome, investors and traders. And boy, do we have another bit of interesting information coming out here in the next few minutes as Microsoft, Google, and we have earnings surprises from Meta. Hopefully a surprise, at least. That'll give us more volatility to trade off of. And as usual, we have Nod from our Nod live feed with us. And we're going to kick things off with what Nod has to tell us, especially with the Fed information coming out today with rates. And of course, we have a special guest, Greg Montwell, who he and I traded side by side in the pits back in COMEX. So we'll have a lot to talk about there. And Nod, what do you have for us today?
AJ, like you said, man, we have so much to cover, not enough time. But thanks all for putting up with me. I'm playing a little bit hurt today, but we're great. Nothing like a casual week of 20 trillion in earnings. After the bell, we have 9 trillion in earnings. Oh, and the Fed cut rates by 25 basis points today. So there's just so much going on. We're like a broken record, AJ. We just got to get after it. So as we speak, AJ, we're going to get earnings from Microsoft, Google, and Meta. So while those come out, and I'm sure we'll talk about it, AJ, when we have those come out, big earnings, do you like to have a position on going in, or do you like to wait for when they come out? And to see where they settle, because I know there's two different schools of thought, and I know a lot of our members, a lot of people on here tend to want to jump in before, and I think that can be kind of a recipe for disaster unless they know what they're doing. What type of plan do you have for trading mega cap names like that?
Well, interestingly enough, this past Monday, Zero Hedge published an article of mine that showed the manipulation behind earnings and earnings estimates and forecasts and such. And I did a lot of research on this one, hoping to get that front page spot. And when I found out that the large majority of the time, we're talking over 85% of the time, when earnings come out, they tend to beat the estimates, which statistically is impossible for that to happen. Just 85% random, earnings coming out. And so it's my belief and the belief of many other traders that those numbers are being manipulated in such a way where they usually lowball the earnings estimates, giving companies a chance to beat the earnings, hence the reason why they beat so many times in the percentages. And so while it's not necessarily a 50-50 shot that you're going to get it right, it is still a very risky proposition to be trading earnings. Now, I normally don't do that, but I do show the option traders often how to use straddles when the prices are right to get in on the option market and then hedge themselves in the after hour market. Now, this is not something the average trader is going to try to do. It's more for the sophisticated traders. And there we go. Microsoft just came out. Oh, as we speak, unbelievable. It's already off to the races. Microsoft is now trading 526 and then now back up to 535. You seeing this? Let me, Anthony, show my chart here. Look at what's happening in the after hours, folks. You've got this big red candle after a green candle a minute after the close. Now, Microsoft is way down here trading 527. This is exactly what we're talking about. Now, 523. Look at that. In one split second, it dropped $4. And so there you go. I can't give you a better live example on why you don't want to be trading the after hours.
Just like we practiced, right?
And then let's see what happened with Google while we're at it. Google, look at it. Look at that candle on Google. So Google right now, I say Google, it's all alphabet. We know that. I'm a creature of habit. Is now trading 285. So that's up $10, almost $11 now. While we're at it, let's see what's happening with Meta. Might as well go right down the line. Meta didn't come out yet. It doesn't look like it's still flat, pretty close to where it closed at 751.67. But I imagine it's going to follow suit as traders brace themselves for what's happening right now. So, yeah, again, the answer, I don't like trading earnings for this very reason. It is all very much manipulated. But if you feel like you definitely want to get in there and do that, I wouldn't be picking the mega cap stocks to be doing it because you could lose your shirt. Rather practice on maybe a more tame and lower price per share stock to give you at least a shot of not suffering a catastrophic loss. So there you go. All right. What do you have, Nod, now after this?
Well,
yeah.
Well, I want to see. I know we've got Greg with us. Do you want to bring Greg on so we can talk on some cool topics that we're going to cover?
Yeah, let me first introduce Greg in a proper way. Dan on the trading floor in Comex. I came onto the trading floor on August 15th, 1982. And I can't help but look at Meta just dropped $20 like in 1 second there. But anyway, Greg and I trade side by side in the trading pits. Many of you have seen the movie Trading Places with Dan Aykroyd and Eddie Murphy. Well, we were actually the traders in that movie, and they hired us as extras to be in there. And that's based very closely to what really happens in the trading pits. So Greg and I go back to that time when it was more or less the Wild West of trading, when it was open outcry. We didn't have any computers on the trading floor when we first started trading in the early 80s because there weren't any. I think my first computer was an IBM Model 50 with a whopping 50 megs of hard drive. I think one email nowadays has more than that. And so Greg and I learned how to trade, and he and I will go back and forth and talk about this. But Greg Montwell is also one of our coaches. Greg, why don't you come on board? Greg,
hey, how you doing, guys?
Good. Greg is the is running the Power Pivots trading room at StickyTrades. And Greg, while we're looking at this volatility, you remember the days when silver was all over the place, when gold and silver both had limit moves that weren't even close to what we have now. It was so much less, and they'd shut the markets down. But tell everyone what you've learned from the trading floor and how you carried that on over with regard to risk management. If you
well, you know, I was very lucky because I actually was working for a company called J. Aaron for some time, and J. Aaron was arbitrage traders. So I was lucky because what they did was they hired a lot of guys from Drexel, which understood the volatility trading, the options trading, and everything else. And I learned synthetic options right from the beginning. Synthetic straddles, which you and I've learned, and synthetic puts and synthetic calls and so on. So that gave me an edge in the pit. So while most people were using computer models upstairs, I had the ability to do a lot of this in your head by and you've done that a lot yourself. And then we used a lot of the market making skills that we learned from watching CRT trade and everything else and making markets. So basically, you take what we learned then and apply it to now. A lot of people don't trade volatility the way you and I do. They don't look at volatility the way you and I do.
So just to give the audience a little picture on what was happening, when Greg and I first came on the trading floor, options had not yet been introduced. They introduced gold first. And I remember the slogan because they were trying to pawn that off as the least of the riskiest, the least risky positions. And the slogan was gold for the not so bold. But in fact, what that was is a derivative on top of a derivative, a futures contract. So it was probably the most risky thing you could trade. And Greg and I were just two of a very small group of traders who had the opportunity of trading options for the very first time on Comex. So we had to learn very quickly on what a call, what a put was, what a straddle, how to trade the synthetics. And Greg, going back to your point, if you recall, we based our pricing off of what the at the money straddle was. That's
right.
All the time. By the way, that was it. If you knew where the straddle was, you can price the butterflies, you can price the spreads, the vertical spreads, the back spreads, all off the straddle price. I remember that.
And that's why when I'm talking options to a lot of folks in our membership, I don't show them my option screen with all the deltas and the gammas. I mean, we didn't use that back then, and I'm not saying they're not important. You got to get the most important thing is getting the direction right. And that's what you do in the power pivot room with regard to picking stocks that may have pulled back using the Fibonacci calculations that you've modified. Why don't you tell us a little bit about how, in general, how the pocket works? That's the term that you have.
Basically, the whole idea of this is following the program traders and the algorithms. And if you go back in time and look at charts over and over and over, as many times you and I've been doing this every day for 45 years, looking at charts, you can kind of see where the likelihood or the high probability turning points where the big players are going to step in. And a lot of times you can calculate that ahead of time from previous moves down or previous moves up that are huge. You can see where the institutions leave their footprint in the sand. You know, there's a big wick in the candle, either direction. We just saw that today, both directions.
Yeah. Do you have a stock that you're currently looking at or trading that I could pull up while you're talking? I could show the audience what you're referring to as the pocket.
Yeah, you can just pull up the E-minis.
Okay, so you're trading which one you're trading? The
/ES is fine.
Yeah, that's why I put ES and it didn't come up there. Okay, so you're looking at monthlies, weeklies, dailies.
Just pull up a 30-minute.
A 30-minute chart, 30-minute candles. Okay, so here we have every candle represents 30 minutes, and we're going back to yesterday's trading session here, actually 2 days ago. So when you're looking at a chart, you're using Fibonacci numbers that you've modified. Why don't you tell us a little bit about that?
So basically, you know, you have your 50%, you have your 618s, you have your 786. So what I like to do is create a level that's almost like, if a 786 retracement, you're looking at an 80% approximation, you know, from the level you're looking at. So I'm looking to buy discounts. So if my 786 or approximately 80% discount from where it came from is a nice discount. So
I'm gonna do this. If you could see my screen, I'm going back to this low back here.
Yeah, that's part. By the way, you hit it right on the head. Matter of fact, go to an hourly. Go to an hourly.
Right, because I have to give the audience a shot, because they, you know, when we start using the jargon, they're not really picking up what we're talking about. But here, so let's
basically, this is great, because what you did was you come back, if you shrink your screen a little bit more so we can see more of it, okay, and bring it over. So basically, look at this consolidation right there before it started, you know, on the gap up. See the gap up right there? Yeah. You hit it right there. So that gap up is catching a lot of people short, okay? And people that did not buy it want to get their longs in. So if you draw straight across, we came back to that consolidation. Came back.
Let's take this low right here. I want to show them how to use the calculator.
Okay. Yeah, I was going to take the first green candle that's in that consolidation right there. Yeah, right there.
Okay, so I'm drawing the Fibonacci retracement calculator. Most people who have trading platforms have this built in, but I'll show you how Greg has modified this. So when you're measuring a Fibonacci pullback level, you go from what Greg refers to here as origination of the move, or the beginning of the Fibonacci, and then you draw it up to a high right here. You see? Now, Greg, I don't know if you could see what I just drew.
Oh, I could see it. Guess where the pocket is.
You see this right here? Now, what Greg has done is he takes the 786, 886. Now, 886 is not going to be one that you're going to find on your Fibonacci calculator. You have to change the 100% to an 88.6%. And that creates, and then he color-coded the lines here so that when it starts dropping below 786, that's what's defined to be in the pocket. Yeah. And that's where Greg finds these attractive.
The pocket represents where the likelihood of institutions and the algorithms have their programs to kick in. So look at how it reacted when it got into that pocket. When it immediately, and our members, our VIPs today, played it using other components from the power of pivots to enhance the probabilities in that trade.
Right. Now let's talk a little bit about silver while we're at it. Let's throw some, because you and I go back to the days of trading silver.
Oh, by the way, we played silver just the reversal 2 days ago.
The futures, or did you go?
We played SLV.
Okay, so I'm going to put SLV in here.
And what we did was we also, like Newmont, off the back of SLV pivoting also.
Yeah, so here I'm gonna zoom in here to this area right here, and let's say this is a low from here. I'm gonna draw the Fibonacci.
But we went to yeah. Well, we can go to hourly. That's fine.
Yeah, I'm doing the hourly. So here is a low right here. You go right up to the top where silver started the break, and what happened? It came right back into this pocket, and then bounced a little bit, and then that pocket became a support level that ultimately broke. But talking about risk management, Greg, when you're in a trade like that, what metrics are you using, or what formulas are you looking at to determine when the get out point is going to be?
Okay, so what I want you to do is because the amount of momentum into silver, if you look left, like you always say, look left to that pivot that took place, and look at the go up higher where we just pivoted in the last few days.
Here?
No, in 3 days ago, 4 days ago.
Oh, here.
Look left. Look what we got. We got a wick.
Right, a shadow right there.
Right there.
And then you got the pocket. Now, when you're in the room, so to speak, when you're in the power pivot room, what is the feel in there with regard to the traders? Are they talking? Are they searching for trades? Are they confirming them with you? What is that? Give our audience a feel for what that might be like in that
Basically,
room.
we created a virtual trading room, a community where everybody's participating. And the way it actually evolved, and this evolved from the conference that we did in January in 2024, where it was fabulous how it evolved and took place. But what happened was we created a community where the guys actually more eyes on screen help one another. So everybody's learning the same methodology, using the power pivots, using the components, and then all anybody has to do is post, let's say BA or Boeing,
right,
or post
and then
Microsoft.
you'll look at it, and
Right.
if it's worthy of the trade, you put it in.
Yeah. Right. So Boeing, for instance, was an earnings play. It came into a pivot level, came in and filled the gap this only a little while ago, and you'll see it right there. There's the gap.
Yeah.
Okay. Right, so that is your target. So if you also look at the origination of the big down move, those two big red candles on your screen, okay, there's your beginning of your Fibonacci retracement to the upside. Where's the upper pocket?
Right.
Okay.
So you're flipping the Fibonacci sequence on its head. You're looking for a place to short it. Is that right?
Looking for a place to short it, knowing there's a gap down below.
All right. So let me show the hourly chart here again.
This is brilliant, by the way. Everybody watching this will have to really, zoom in on this. The down move from there, keep a move. That down move is the canary in the coal mine. Big institutions move that very quickly. So what happens is people that were caught long can't wait to get their money back. Remember that?
Right. We're talking about this down move right here, folks. Yeah.
Okay. So notice the way it stair steps up back to that level.
Right. It just steps up and then comes into the pocket right here, which when you're doing the Fibonacci's to the downside, you start at a high, you end at the most noticeable low here, and then you drop the calculator down, and it's going to calculate your area of where, if you're long it, you're definitely getting out if it's at that level. But if you're looking for a new short or buying puts, that's where you're going to be getting in.
Or we've been playing from the long side, and this is our exit.
Right, right.
And now we can get back in when it came into the gap only today.
Right. So
which goes back to the daily. Go back to the daily.
It's a more concrete way of getting in and getting out without watching CNBC for them to tell you how to trade. Number one, that's not going to happen. But number two, you're taking the second guessing out and you're pulling the emotions out as well. Because if you get, as you know, Greg, you get your emotions tied into any trade, that's the beginning of your problems right there when you start getting emotionally tied up
Well, that's
in that trade.
the big problem in risk management, because it's got a psychological effect on people once they put their money at risk, and
Right.
and it's very difficult. So options makes it a lot easier.
Yeah.
It gives you a lot of different variations to manage your risk. Now, the one thing that I go over with the guys, and this is key, and you and I go over that with your group too, is when you trade anything, whether it's currencies or commodities or silver or gold, you have four outcomes. One outcome is a big win. The other outcome is a small win, and then a small loss or a big loss. So the key is eliminate the big loss, and the probabilities are now in your favor, and that's how you become.
And that sounds easier said than done, as we all know.
Well, you hit it right. You hit it right on.
Yeah, maybe we'll have you come back and talk about some of your option strategies that you're working alongside these power pivots. But I know these half hours go very quickly. Nod, I'm looking at Nod on the screen here, and I think he's got some ticker symbols from the audience.
Oh, okay, cool.
To look at here. Nod,
yeah, that'd be awesome. Yeah, this has been awesome content. I appreciate it. Listen, Ray was first on. He wanted to know about Netflix. Can you guys look at Netflix for Ray, please?
Does Ray have a position on this or not? I mean,
that's not included. No.
See, now Netflix, again, talk about volatility. It's one of the higher priced stocks. I don't think there's many people that are outright trading Netflix on a per share basis, but it's great for option trades because you have that volatility. Now, at first glance, I look at this and I go, man, look at that gap staring me down here. But as Greg mentioned before, when you look to the left, you can see that there's a support level down here. Can everyone see this? If you're not careful, you're not going to know what to look for. But it's a little bit of a pivot right here. If I take that low and I just draw it right across as straight as I possibly can, there's a support level. Now, if you were to pin me down and say, would you buy it or would you sell it? I wouldn't be selling it here. But I'd be waiting for more of a pivot to the upside before I would be willing to buy it. And I would probably be more of a buyer than a seller at this particular point in time. Because if you take out your trading checklist, for those members who know what that is, you're basically looking at the signals. You're looking at the buy signals versus the sell signals, and you're more or less putting on the scale and you're weighing that out. Now, yesterday we had a bullish engulfing. Today, we have just this little spinning top, almost the doji. That's going to be more, because yesterday was a pivot. That's going to be more of a buy, right? Now, we've had the drop in volume. You see this on the way down. So a drop in volume on the way down is more bullish than bearish because it tells us the sellers are losing that momentum. We have a wide divergence from that 20-period moving average. That is bullish. We have a gap above the market that's bullish. We've got the stochastic oversold and starting to move up. That's bullish. And just yesterday, we had a buy signal on the CCI way down here when the blue line, see that blue line crossing the green line? That's the minus 100. So that's all bullish, bullish, bullish. Therefore, I don't see any sell signals, so I'd be more on the buy side for that. Greg, just look at Netflix. I'm going to put you on the spot here because we only have a few minutes left. If you, let's say you determined that Netflix was going to go to the upside, what kind of option play would you put on that one?
You know, what happens on things like this, I do like the calendar spreads for one reason, is because you're looking, you're long deltas, and you go out further, you do the 90-day or 40-day calendar spread to the upside for the reversal to fill that upper gap.
Yeah, and that's a pretty big gap. I don't know if it's going to fill right away, but I would agree.
Like you said, it's not going to fill it right away. That's why the calendar spread can come in handy.
Yeah, just for our viewers, I'm going to throw something out here, and then we're going to cut you loose, Greg, as we get into the wrap up here. But you look at you go out now. A shorter term calendar spread, I would probably go closer to March, but you might go.
No, March is where I'd like to do it. Yes.
So I would look to buy like maybe a March leap call at around the 1180 level. Maybe you can get something around $67 there, and then I would be doing a horizontal, and I'd be already selling December's right now at that same level, right around the 1180 strike price. And you could see that there is quite a bit of volatility there. Look at that. You could sell those for very close to $22 here, almost $23. So if the stock goes up to 1180, and I'm talking closer, not all the way, but closer to filling the gap up here, which is just over that moving average, you can make a lot of money on a horizontal calendar spread like that. And that's how the professionals trade it right there.
And you hit that right on the head.
Yeah. So, Greg, thank you so much for joining us. We're going to cut you loose, and Nod's going to give me some ticker symbols from the chat board that's rolling like crazy right now. So thank you for joining us. We'll have to have you back. We'll talk more options, and we'll talk to you later. Take care.
That was awesome. It's like you guys traded together for 40 years or something, AJ.
Yeah, I know. It's
great. Listen, the cool thing is at 6 p.m. Eastern, you're going to be doing this 50 tickers. You're going to field them live from our members and rapid fire. So if you're not a member of our community, please come on in. It's completely free. StickyTrades.com, 15-day trial, no credit card, nothing. Come on in. AJ, let's look at Daryl. Daryl wants Adobe, please.
ADBE.
Please.
Here's another one that's, look at this. Look at this. Now, I had a couple of weeks ago, see this little diagonal line? I had an upside target on Adobe at 341, and I thought that was a far stretch because I was looking for it to come back to the moving average. And then, bam, it gets smacked today with a big red candle. Now, there's no way I'd be buying that right now, but I think I'm safe in saying that's probably going to pull back to a support level down here. And while it doesn't look like much on the chart, you're talking about another $7, almost $8 to the downside. So I would put a target on that one right around 331. I'll keep that up there. Maybe we'll look at that next week. 331 is my downside target. Yeah, so we got about 50 of those that we're going to be doing in an hour, starting at 6 o'clock today. So thank you, Daryl. What do you have another one for us or a question?
Oh, yeah, I got a lot, man. Listen, Marina wants to go back to one of your favorites, PAAS, to the Silverland, please.
All right, and then I want to end on silver on the difference, because there was a question that came up last night that I didn't answer between PSLV. Now, I am more bullish in silver and than I was obviously last week, but I was expecting a correction right across the board between the silver ETFs, silver futures, and the miners, and we got that. But I have an upside target already established on Pan American Silver up here at 38.11. So we got about another $3 to the upside. So you're talking almost 9% to the upside here. I think there's a good shot of that hitting because of this open gap right here. Now, what was the exact question that we had between SLV and PSLV? What was?
Sure, this is from one of our longtime members, Dale. He says, last week, AJ mentioned a couple times that he's moving some of his position from SLV to PSLV. I understand that there's a potential default in Comdex as LMBA is already showing signs of issues. Can AJ please expand on his comments of PSLV having less risk?
Right. Well, let me first talk about what the possible default could be. There's a silver shortage, no doubt. And COMEX, which is basically facilitating the delivery of silver to those who buy silver futures contracts, there is an absolute silver shortage. That's why I still feel comfortable buying the silver miners and the actual silver ETFs. However, the big difference in why I'm switching or slowly, it's not like I'm turning the switch on and I'm just going to turn all my SLV that I've been trading for 17 years off over to PSLV. For me, it's basically a trust issue. And it stems from JP Morgan being the custodian for this BlackRock ETF.
Now, why don't you trust JP Morgan?
Well, without getting us into too much hot water, I could state the facts that it wasn't too long ago. They were fined. It was like $920 million, almost $1 billion for manipulating silver prices. So JP Morgan is holding the silver on behalf of BlackRock as the custodian to mark this ETF in its value against that silver. Now, that's like having the fox guard the hen house, if you ask me. Because if there's a silver shortage, the world is looking for silver, and JP Morgan has the keys to the warehouse.
Right.
That's number one. Number two, if there is a squeeze, there really isn't any physical silver backing this. It's a valuation on silver. Whereas PSLV, and this is very important, and I got 30 seconds to explain this. PSLV is held, physical silver is documented and made public by the Royal Bank of Canada. So they're actually holding the physical silver. This is a closed-end fund that has an inventory that's accounted for. And if you own enough of this, you could redeem your PSLV shares into physical silver and the Royal Bank of Canada will deliver that absolutely to you. So that's where we're going to have to end on this broadcast here today for the 29th of October. For those of you that are going out trick-or-treating tomorrow, all right, we got a trade out there on Hershey. I'm not going to give you exact details, but that's our seasonal trade. And we love Hershey this time of year, right up until February 14th. And I'll end with that. Nod, thank you so much. Greg, thank you for joining us. Thank you, everyone. Thanks for the comments, the ticker symbols, and we'll catch you next time. Have a good evening. So long.